Hi, thanks for tuning in. My name is Stuart Johnson. Today we have a special guest, John Hamburger. John heads up Franchise Times Magazine and the Restaurant Finance Monitor, two of our leading trade publications in the industry. For almost 20 years now, he's sponsored two annual conferences, the Franchise Finance Conference in the spring and the Restaurant Finance Conference in the fall. Both are executive level conferences and forums for leaders in our industry across the country. If you're already watching this video, you probably know who John is, so it's a real treat to have him here today. John's going to talk to us today about how financing has evolved even through the tough economy to benefit resales and how sellers can take advantage of it.
Banks have tightened their criteria for new unit development, and it's made it much harder for new franchisees to open units. And this has opened the door for sales of existing units because banks can take a look at an existing unit and see some history and see how they've performed. It's much easier to underwrite an existing operation than it is to underwrite a blue sky where you're just trying to estimate what the sales are going to be. Plus you have the ability in the sale of an existing unit to have the owner provide some financing to make up the gap for the difference between what the bank is going to put up and what the buyer is going to put up. You may be able to get your asking price if you provide some seller financing. Well, I think on bigger transactions, I'd say maybe $1 million plus, those would probably be cashed out. But on smaller transactions, I think owners need to think about financing the transaction. Another reason why I think sellers should think about financing if they want to get their price, if you think back, 5-10 years ago, buyers of franchise units had a lot of ways to finance a purchase of a franchise. They had home equity loans. They were able to tap their home for funding as a down payment. They also were able to tap into their 401k. And a lot of this funding has gone away because of the economy. And so the way to fill that gap, it would be for an owner to step in and provide some form of financing. Just practically, between the buyer and the bank, they may not have enough funds to get what you're asking for.
I want to provide some quick examples about how you might structure seller financing using the documents that we provide here at Franchise Smart Market or through your attorney and some of the questions you may want to ask. One of the questions sellers often have about seller financing is, well, how long do I have to wait for my money? And so it's a natural question. And part of the answer is, well, we can do two things at once, which is, number one, keeping the payments low, and number two, getting you paid off in a reasonable period of time, typically 2 to 3 years. One example is this. Let's say that you financed $100,000 at 8%, and we structured that over 10 years. You'd have your monthly payment, but then in month 36, at the end of 3 years, there's a balloon payment to pay off the balance. There's a couple of reasons for this. One is that if you keep the monthly payment low and achievable, you're more likely to get it, and there's not going to be a collection hassle and everything else. You want your buyer to be successful, and you want your buyer to be able to breathe. You want your buyer to be able to have some room, because if they're stressed, unable to make the payment or something, you're just setting yourself up for a kind of disaster. Last, banks are unlikely to finance that last portion, that amount, until a business operating history has been established, which typically is 2 to 3 years. So while many sellers want to offer financing that gets paid off in just 12 months, it's really not realistic in most cases. And probably if it was realistic, it wouldn't be necessary in the first place. Keep in mind, it's keeping your payments low, but with a balloon payment in the first few years can be a great strategy to achieve both ends, which is making the payments realistic, but also getting yourself paid off more quickly.
And I don't think it's a bad thing that they do it. Because if you think about it, you cash out, what are your investment alternatives? You can put your money in the bank. CDs right now are under 1%, one-year CDs. And if you can provide seller financing at say 6%, 7%, 8%, that's much better than you're going to do with putting your money in a bank. The other advantage of that is that there might be some tax advantages to taking your money over time and not taking it all at a lump sum.
As a seller, you have a variety of resources available at franchisesmartmarket.com. Not only do we have the legal documents that support the kinds of ideas we're talking about here today, and many others, such as the purchase agreement, bill of sale, letter of intent, mutual non-disclosure agreement, financial qualifying statements. Following a step-by-step process, people get answers to questions more quickly and really accelerate the process and the exchange of information back and forth so that you reach a closing date and get to the end successfully. The boardroom is a virtual meeting space where you'll move the transaction forward with your buyer. But it also includes your team. And your team can include your attorney, your accountant, banker, partners, or others that are all involved in the transaction so that no one skips a beat. You'll be able to monitor the transaction as they go through step by step. Members at FranchiseSmartMarket.com have access to our valuation tool and in-depth instruction and walks you through a step-by-step process that just about anybody can do, and you can run different scenarios as often as you'd like. I want to thank John for his comments today and time. If you've got a great story to tell that you think is a good fit for Franchise Smart Market, drop me a line. Thanks.